Okay, let's dive right into this explainer. Today we're unpacking a detached, purely evidence-led analysis of the historic July 29, 2026 market repricing. By sticking strictly to the facts, the verified data, and the official statements, it actually becomes really clear how the Federal Reserve's July decision interacted with concurrent earnings and geopolitical developments to shake up global bonds, currencies, and AI-linked stocks.
Here's our roadmap for methodically unspooling all this data. We'll start with the hawkish policy hold, then look at the yield curve repricing, track the exact chronology of the tech sell-off, examine the uneven global market reactions, and finally wrap up with macroeconomic constraints and what still remains unknown.
So here's the central analytical mystery of this whole event. The Federal Reserve actually didn't raise rates. They held them steady at the 3.50 to 3.75% range. And yet markets reacted almost exactly as if a hike had occurred, sending long-term Treasury yields surging and tech equities tumbling. Well, this forces us to recognize a core truth in monetary policy. A hold on interest rates is absolutely not automatically dovish. To understand why, the voting mechanics give us our very first clue.
Section 1. A hawkish policy hold. Unpacking the 9-3 decision.
And this brilliantly illustrates exactly what made this pause so unusual. The July 29th decision marked a really rare departure from the consensus-driven model we usually see at the Fed. While 9 members voted to hold the target rate, 3 official dissents emerged from Beth Hammack, Neil Kashkari, and Lori Logan. All 3 of them formally favored a 25 basis point hike. That signals some very significant internal hawkish pressure.
But it wasn't just the vote split. The communications from the central bank were remarkably firm. Chairman Kevin Warsh hammered this exact point home during his press conference, stating that 5+ years of inflation above target cannot be cured in 9 weeks. That language reinforces a strict, unwavering dedication to the 2% inflation target. It basically left zero room for market participants to assume a pivot or any easing of policy was on the immediate horizon.
Chairman Warsh also formalized a major structural shift in how the Fed communicates, specifically a formal reduction in forward guidance. He explicitly told markets they must play the ball, not the referee, meaning the era of the central bank predictably hand-holding the market through its next moves, that's paused. The Fed is now strictly data-dependent. The big takeaway here is that the risk of forecasting the policy path has essentially been transferred right back to the private sector.
Let's move to Section 2, the yield curve reprices, and see how this builds into rising long-term borrowing costs.
The immediate mechanical reaction in the bond market to this lack of predictability was a phenomenon called bear steepening. For anyone newer to bond mechanics, bear steepening is just a shift in the yield curve where long-term interest rates rise faster than short-term rates. And why does this matter? Well, because long-term yields act as the discount rate for asset valuations. When duration risk goes up, the present value of future earnings drops, and that disproportionately hits high-growth businesses.
Now, what's really interesting about this slide is how perfectly the bond market's reaction mapped to the Fed's communication. The 2-year yield actually fell slightly, by 1.1 basis points, but the 30-year Treasury yield, it surged 11.6 basis points to 5.212%. That steepening curve aligned precisely with Chairman Warsh's press conference remarks, right as markets digested the withdrawal of forward guidance and that strict 2% inflation target.
On to Section 3, the tech sell-off chronology. Let's look at what actually moved first.
There's a highly disputed narrative floating around the financial media that the Federal Reserve was the sole catalyst for the massive tech equity sell-off. But if we're being strictly analytical here, we have to separate chronology from assumption. The tech decline was absolutely a multi-factor event. Just look at the timeline. The weakness actually began during the Asian trading session on July 28th, hours before the Fed's statement. SK Hynix reported earnings that missed operating profit estimates, immediately sparking fears over artificial intelligence capital expenditures before the Fed even said a word. Which introduces the $725 billion question. The big hyperscalers, Alphabet, Meta, Microsoft, Amazon, are committed to roughly $725 billion in combined 2026 AI capital expenditure. Like the timeline just showed us, organic anxieties regarding the return on investment for this massive infrastructure build-out had already crystallized. Investors were heavily rotating out of the semiconductor sector, sending the SOX index down 5.33% because they were questioning the timeline for profitability amidst rising costs. The Fed's higher discount rate certainly exacerbated things, for sure, but it absolutely didn't start the fire.
Section 4. Uneven global market reactions.
let's examine the disparate regional equity reactions. Taking a broader geographical lens reveals how different global regions process this exact same confluence of data. The intensity of equity losses actually varied quite significantly. While the US Dow fell 2.19%, the impact was massively outsized on tech-heavy overseas markets that felt the full brunt of that SK Hynix catalyst. The TAIEX fell 3.76%, and South Korea's Kospi plummeted nearly 6%. Europe, by comparison, saw much milder declines overall.
At the exact same time, major volatility emerged in commodities, specifically oil. Brent crude climbed 3.9% to $87.39. It is absolutely vital to delineate that this concurrent surge was strictly a mechanical reaction to geopolitical realities, specifically shifting prospects of a US-Iran ceasefire versus renewed hostilities in the Middle East. It was completely independent of the Federal Reserve's monetary policy, which just further proves that July 29th and 30th were driven by overlapping, distinct global forces, not just one single factor.
Moving to Section 5, Slower Growth, Elevated Inflation, the Macroeconomic Constraints on Policy.
So the crucial point here is understanding the macroeconomic backdrop that really constrained policymakers from offering any kind of dovish relief. When you juxtapose the data from the Bureau of Economic Analysis, a highly challenging picture emerges. The Q2 advanced estimate showed economic growth decelerating to just 1.5% annualized. Yet at the exact same time, the GDP price index increased at a massive 6.3% annualized rate.
Anchoring our analysis strictly in this confirmed data reveals the precarious tightrope the central bank was walking. With real economic growth slowing down to 1.5% and core PCE rising 3.4% quarter over quarter, the U.S. economy is basically facing the risk of stagflationary dynamics. This toxic combo of slowing growth and persistent elevated inflation metrics is exactly why a 9-3 hawkish hold was the outcome. A simple market-friendly pivot was completely off the table.
Finally, Section 6, What Remains Unknown. Looking ahead to what's next. Any good evidence-led analysis has to establish the boundaries of what we actually know, and right now, it is impossible to definitively state the Fed's next move. However, as of July 29, market pricing implied roughly a 60% probability of a rate hike at the upcoming September meeting. That makes the immediate policy path a totally unresolved, highly consequential variable for global markets. So, to navigate this new reduced guidance environment, here is the watch list of data points you need to monitor. Upcoming labor data will indicate how those September FOMC probabilities shift. Immediate mega-cap tech earnings from Apple and Amazon will act as a gauge for ongoing AI capital expenditure sentiment. On the global front, geopolitical developments, particularly concerning the Strait of Hormuz, could act as an unexpected supply shock to inflation. And finally, the initial findings from 5 structural task forces established by the Fed are due by year-end. All of this prompts one final synthesis question for this explainer. The Federal Reserve is actively pulling back its forward guidance, establishing the 30-year Treasury yield as a higher, much more volatile hurdle rate for global capital. At the exact same time, these massive hyperscalers are locked in an arms race requiring staggering capital expenditure. So, how will the market reconcile structurally higher long-term borrowing costs with the unprecedented $725 billion infrastructure demands of artificial intelligence? That clash between tight monetary policy and massive corporate investment is absolutely the definitive financial story to watch in the data ahead.